Welcome to my market commentary for the last quarter of 2023. Well, this quarter continued to be extremely volatile, with markets dropping heavily in October as fear over war in the Middle East took hold. Oil prices temporarily started to rise again, thus threatening to lift inflation. Meanwhile, US and UK government bond yields fell in September from 16-year highs, only to go back up again in October before falling notably again in November. So what is currently going on? Well, it's beginning to look a lot like the 1969 US stock market right now, not Christmas. The past 2 years have been fairly brutal, as oil and energy prices have ratcheted up inflation. Central banks, especially here in the UK, were slow out of the blocks and then scrambled to raise interest rates at alarming levels, which hiked the yields on bonds and spooked the markets, thus decimating bond and equity values around the world. Probably the only market that seemed fairly impervious to this pain was the FTSE 100, but this is not surprising, as the FTSE 100 represents large amounts of oil, energy, armaments and tobacco companies. For the past 2 years, global markets have predicted a recession that technically has not arrived yet. In September, it became apparent that the Federal Reserve and European Central Bank were just about done with interest rate hiking. There was a sense of potentially a crisis averted as Janet Yellen, the US Secretary to the Treasury, came out with a statement that a soft landing had been most likely achieved in the US. Now, keen 2007 market historians will shudder as they recall Miss Yellen's similar remarks some 16 years ago, just before the mother of all recessions and global market crashes. However, this time things do appear to be very different indeed. Whilst the US, UK and Europe are not exactly enjoying times of great growth, they do appear to be skirting recession by the skin of their teeth. Even if the dreaded recession label is earned in the coming months by one of these economies, the likelihood of a deep recession seems very slim at this stage. And there are signs to actually be cheerful right now when it comes to the global economy. Interest rates do appear to have hit a ceiling, and barring an outright war in the Middle East, inflation does seem to be slowing down. This has really helped bond markets over the past months. And it's also helped a lot of the growth funds that have been so badly smashed over the past 22 months. Indeed, we've noticed some truly stellar returns for these types of funds throughout November. All of this is before any Western central banks have cut interest rates. The trouble with markets is that they are very binary. They either see recovery or recession, and they so often fail to plod along in between. This is why investing suits the long-term plan, as markets will sell off too much during gloomy news and put on too much value during better news. Our humble guess, and it is only a guess, is that we are nearing the end of the tunnel of gloom. However, it might just be possible that markets have got carried away in the past few weeks, and some correction is probable if recession is confirmed, albeit only very small. We think that this could still happen in the early part of 2024 in the United States. In a weird way, the world almost needs a technical recession. It needs it to happen so that it will draw a line under the inflation chapter. Then we could see central banks rush back to the stimulus pump and start cutting rates. This would be like Christmas for fixed interest securities or bonds, and in turn would also help to lift those growth funds that make up so much of investor portfolios around the world. It's been a truly grueling 2 years now, but we have been able to still grind out some results over that time. You may recall me saying over a year ago that we hoped for a swift rebound as our plan A, but we would fall back on Plan B if needed. Plan B was a gradual and slow recovery based on patiently reinvesting dividends into our clients' portfolios. This is the course that we've needed to follow, but it is slowly working. The majority of our client portfolios have now beaten the FTSE 100 over the past 6 months, which shows the turning of a corner, we think, as the FTSE 100 reigned supreme whilst interest rates were rising so fast. 2024 looks quite exciting to me. I think it could present some challenges early on. However, if the world can avoid more wars, I do predict a very pleasing recovery in markets as the year moves on. I'd like to take this opportunity to wish you a very happy Christmas. That's not a Christmas tree behind me, that's a potted plant. I'm in the back room today because someone stole the lead off the roof, and so we've got scaffolding all over the front. But anyway, I wish you a very happy Christmas. I pray and hope and pray that it's a calmer one for you, and that we have a truly prosperous 2024. As ever, I'm here for you. If you need anything at all, let me know.